Hey everybody, welcome to the morning market briefing. It is Wednesday, July 15th, 2026. Hope you're doing well out there. Tom's doing a little data digging, but while he's looking up PPI, Ben, let's open with some interesting stories. I never would have thought I'd see the day where there's at least rumors and reporting that PayPal would be taken down by Stripe and Advent.
Yeah, so Advent is a private equity company, I think, in Europe, and then Stripe is a privately held company worth about $140 billion, and PayPal is now a small company. What's crazy is PayPal was over $300 a share during COVID, and now it's getting bought out at a 20, or could get bought out at a 20% premium by this group, combination of Advent and Stripe. I don't know why Stripe would want Advent as a partner on.
Yeah, it seems odd that they're bringing one in.
And I think the reporting was a little bit flimsy on it. I would not be surprised if this deal didn't come through. Stripe was already looking at PayPal back in April, so at the very least, it's a very slow-moving deal. So we'll see what happens, but the joint offer is supposedly at $60.50. We'll have to see if that ends up going through.
Meanwhile, Lucid Motors, you may remember from, I guess, the SPAC days. What that was, can you remember which that one was?
No, but that was a big one.
Yeah, it was one of them. But anyway.
The Lucid Air. There's Lucid, Polestar, and Rivian. And Rivian seems to be the only one that's really...
Yeah, and Lucid stock got absolutely hammered when there was a report that they were warning of Chapter 11, and they're now saying that that's not happening.
Yeah, so Lucid is owned by the Saudi Public Investment Fund, as well as having it be in the public markets. And there's this report, and this is where you just really have to understand the source. I mean, there's this report from electric-vehicles.com.
Which I would argue, like, if you don't follow the EV space at all in a professional manner, you're probably like, that must be the foremost authority on electric vehicles. It is not.
And at the very least, you wouldn't expect them to have the inside track. I mean, they basically seemed to imply that they were talking to a private equity firm in this corporate action or an investment bank, and like they might have the inside track on the next hot product, maybe, but they're probably not going to be able to. They're not going to have the Rolodex of investment bank contacts over something like Bloomberg or Wall Street Journal or Reuters.
Yeah.
So I don't know why they would get that story. And Lucid basically said, no, that's total fake news. We're not going to go Chapter 11. And it also kind of defies the logical test. This is a company that's backed by the Saudi Public Investment Fund. Of course, they're not going to just default. They have plenty of backing. So you just have to think instead of just reacting. But the stock did trade down 50%, and now I think it's down 4% pre-market. So, just a rotten story.
Fake news, they say.
And
fake news.
And what's crazy is that I think that you'll see more and more of this because AI doesn't have discernment. Mm-hmm. And AI and algorithms, they're going to trade on this because they view it as truth. And it isn't. And I think that you can create a lot of manipulation either with AI, but certainly enabled by AI that creates moves in stock prices that behoove your portfolio. I mean, whoever wrote this might have been short the stock, been able to cover, doubled their money.
Yeah, I like that move. We'll come back to some other company news, but Tom, I feel like you're itching to get some data out.
Yeah, so yesterday we got CPI, which came in surprisingly cold. And today we're getting PPI, which is also surprisingly cold. So the expectation was for PPI, which is the producer price index, so think wholesale side of the economy, was expected to come in at 0.0 month over month for June, and it came in at negative 0.3. X food and energy expected to be 0.3. It came in at 0.2. And then super core X food, energy, and trade expected to come in 0.3, came in 0.1. So the overall final year demand fell from 6.5 to 5.5% month over month. So a full 1% drop. And then the core fell from 4.9 to 4.7. Super core was flat 5.1. But notably, there's also a major revision of last month. So if you think back to last month's call, we were absolutely blown away by the number. It was really surprisingly high, with a 1.1% move month over month on the headline, and then a 6.5% print on the year over year. So both those have been revised down quite a bit. So they revised the month over month down 0.5% from 1.1 to 0.6, and the 6.5 down to 6% last month. So basically back to where it kind of was expected to be. So all of the, gnashing of teeth and crying about PPI zooming, to levels unseen before, really getting deflated today. Though I don't expect people to go back and be like, oh man, remember all those bonds we sold because PPI was running out of control? I don't expect them to eat crow on that. But notably, before the market opened this morning, or before I guess we got this data, we were seeing bonds sell off again to levels higher than they were yesterday, despite CPI.
Which is crazy.
I think a lot of that has to do with the testimony that Kevin Warsh gave yesterday. And of course, we'll recap all that, but bonds reacting really nicely. Everything now returning sort of to normal levels up across the board, with the exception of the 30-year, which is still at a 5.10, so slightly higher than it was yesterday, but it's functionally flat from right before we got CPI yesterday. So I don't know what it's going to take for rates to come down based on this data, which is now, trending the correct direction. Not only that, but the ones that were really sticking out have now been revised down. So the expectation that inflation is going to get running out of control based entirely on energy prices, I think, is that narrative's got to die. It may die hard, but I mean, the month over month, just in this PPI, energy was down 6.4%. But not only that, but foodstuffs was down.
All the stuff.
Trade was only up slightly. I mean, there's really not, transportation and warehousing was down. So the vast majority of things in the PPI, and of course, energy is going to affect that more because it's an input as opposed to a final product like CPI would indicate. So I just don't know where people are seeing the runaway inflation now. I mean, we top ticked, and not only that, but they've now revised down the top tick. No thoughts?
Well, I'm just curious to see. I mean, when the bond market starts to actually take this seriously, and I'm very surprised that we opened today higher than.
Yeah, I mean, what's notable is that
even with the worst commentary, which we'll get to.
So the 10-30 spread, so the difference between a 10-year Treasury and a 30-year Treasury, has actually narrowed quite a bit, and so we've backed off of buying as many long-dated Treasuries because honestly, the value is not nearly there as much as it was earlier in the year, because what's happened is the front end of the curve has come up quite a bit. The 30-year is basically back to where it was. So the rate of change on the 10-year has actually been significantly more damaging. And so, a 10-year Treasury yielding, call it 4.60 is actually much better value now than a 30-year at 5.10 versus where we were when the 10-year was, call it, at a 4.15 and the 30-year was at a 5. So the middle, the belly of the curve, and even kind of the short end is really where there's best value, bang for your buck, duration wise right now. So the landscape has changed, but I expect that to be short lived. I think that sooner or later we're going to see people move away from the idea that we're going to get rate hikes. And I mean, if you look just kind of week over week, the expectation kind of topped out at 1.5 hikes last week for this calendar year, and now we're at 1.3, and that continues to tick downward. So, I mean, I would still think it's possible we could get a cut this year. I may be moving away from my 1, maybe 2 to a hard 1 cut, but things are moving in the correct direction.
Ben, on another company note, Richemont. How do we say this? Richemont. Luxury brands, crushing it.
Yeah, so they are the parent company of Cartier, which I think we know how to, is a little bit easier to pronounce. But
Cartier.
Yeah, they absolutely crushing it. And I think that this speaks to kind of the underlying strength in the economy, specifically here in the United States. In the U.S., they did accelerate to 27% year-over-year growth. Europe was consistent at about 11%. Asia Pacific up 21%. Japan up 36%. Asia Pacific led by Korea and Taiwan. So
No way.
So the wealth effect seems like it's happening there. The only real bad area was in the UAE, where they said tourism demand was down.
Shocking.
So not a surprise there. But I think that's a sign that the economy is doing pretty well. The other sign is we were just talking about economic data. The Empire State Manufacturing Survey out of the New York Fed showed new orders really ripped up higher from 3.5 to 22.2 in July. Prices paid, to Tom's point, are coming down 61.0 to 52.5, received 31.4 to 27.6. So we're seeing price increases slow. And that fits exactly with what we're seeing in the PPI. That's what we're seeing in the CPI. The other thing is, I would say, I know I have been somewhat concerned about this pull forward in demand, and I've been looking at this a lot, whether it's Fastenal's earnings yesterday, some of the economic data that we're starting to get here in early July or late June, and then what companies are saying as well. And really, we haven't seen a downtick here in early July. So things continue to be fairly steady or even improving over the last few weeks. And I think that's a huge positive as we look into Q3, because there are more headwinds in Q3, but the strength of the economy may just be enough to offset that. And that's very impressive.
Yeah. OpenAI, saying that they're going to have a physical device that will be a physical manifestation of ChatGPT. It's going to have a personality. It's going to proactively learn about its owner over time. This doesn't sound scary at all. What is the device going to be? That's my question.
It sounds like it's a speaker with arms that can move.
Ooh.
Man.
So basically, you could be like a parrot. Like you could be a pirate and have like a little.
I hope it looks just like the parrot toys that they sell at Cracker Barrel.
Yeah,
You know what
it sounds like? Furby. That was basically the pitch of the Furby, is that it learns you and then eventually speaks English, but doesn't at first. It has to learn English from you.
Yeah, it's going to be interesting. It's going to move on its own, but a lot of these details are very vague. So something to either get excited about or terrified by.
Apparently, it learns about you and from your digital life and your emails. So it definitely doesn't listen to your conversations, but just reads your emails.
Yeah, it's going to read the emails, and they're going to be like, Andrew's definitely attending that lunch that he was invited to.
Maybe I think Chris Waller might already have one, which is why he's walking around saying he doesn't know what pornography is, just to make sure that his OpenAI thing doesn't blow him up in public.
Like, let the record show. Press release.
You hear that? I don't have any idea what that is. Stop looking at my search history.
Let's come back to Warsh here in a minute. Ben, take us on a quick tour of some company reports.
Yeah, just wanted to do it a little bit differently, talk you a little bit about what the thesis is with some of these companies and why we're seeing the reaction that we are. ASML is really the key provider of chip equipment, chip manufacturing equipment. So especially think memory chips, and they reported overnight, and they reported outstanding results, big inflection. So the thesis was very much validated this quarter. We do own some ASML, and we'll continue to buy some as long as it dips. I don't think it's going to rip on these numbers because expectations were already high. BlackRock came out. They're up about 4% now. They're over $15 trillion in AUM. And the big theme there is that as they get more scale and they get more in private markets, which they're doing extremely well at, they're making a lot of money in that business. You're going to see margins increase. I mean, their margins are approaching 50% now, which is impressive in the asset management industry.
Yep.
And speaks to the scale.
It's such a great strategy to be like, get into all of our very expensive private products, and then when people are like, hey, I'm worried I should get out there, you're just like, nah, It's a great way to push margins.
Or no, okay, fine, we'll get you out and we'll move you into this other very expensive product.
They're like, you get to be in here for 10 years and you can't do anything about it. Sorry.
But that's actually a feature, not
It's
a
a
bug.
it's a feature.
Yeah, that
For
is
them,
by design.
For them, yes. It's a great business to be in, the business of taking people's money and charging them a lot to hold it and not letting them have it back.
And I have heard that quote in what you guys are saying right now. Feature, not a bug, on everything like that. You're locked up 10 years. That's good for you.
Yeah.
Because then you won't get in your own way.
It's really it's really the strength. We don't
Yeah.
want you making emotional decisions.
We don't want your money to be your money. We want it to be our money.
A couple healthcare companies, too, big healthcare companies. Elevance, the parent company of Anthem, which runs Blue Cross Blue Shield, as well as Johnson & Johnson, reported. Big theme here is, I think, MAHA/GLP-1s are coming for everything, especially on Johnson & Johnson. You saw cardiovascular procedures just crash. They were comping over 10%. A lot of that was due to pricing, and now they're down at 3 in a quarter. So this comes as Johnson & Johnson is trying to spin off their medical device business, which includes a large cardiovascular business. People are getting skinny, and they need fewer pacemakers. And then Elevance is seeing big time margin improvement due to a lower medical cost trend, which basically means that people don't spend as much time in the hospital and cost as much money. And that hurt HCA Healthcare yesterday when they warned on their quarter. And so I think healthcare remains an industry that's very much in flux right now. And it's less so right now because of the government, although I do think that the government will come back and try to put pressure on costs. But right now, I think their issue is that people are healthier, and most of healthcare makes money based on people getting sicker.
Yeah. You don't need a doctor if you're well.
I mean, I've been going aggressively at using Grok to optimize. Been doing some blood work. I plugged my 23andMe in there. Just built out an entire project in Grok on how can I optimize my blood work and all these different things. And honestly, unless you have a gunshot wound or a broken arm, I think you can do quite a bit of heavy lifting on the doctor side without an actual doctor. And I think that that's bad for companies like HCA. I mean, I think there's so much information out there. You can just be like, all right, what does this
Yeah, how
mean?
do I fix this?
Yeah, there's like 5 things that are like, hey, you're kind of in this range. Like, all right, well, how do I fix them? And it'll give you, 10 different ways to attack it, supplements, all kinds of stuff. It's really interesting to kind of deep dive into that. And that's been a minor project running in the background that I've been working on. I think it's so interesting. I mean, even stuff to the DNA stuff where it's like, hey, you're more likely to have this, and that shows up in your blood work, and here's how you can attack that.
And if you're healthier, you don't need those expensive drug cocktails or those expensive surgeries or those long hospital stays.
Expensive what tails?
I knew you were going to say that.
Walked right into it. Let's get to worst, Tom. Worst comments yesterday. Market taking it as, hey, we need to stay pat and we're not getting a cut. But how would you interpret the whole narrative?
I mean, I think that Kevin Warsh is very shrewd. And I would also encourage people to turn off their tweet alerts for Nick Timmerhouse and start watching Colby Smith, because she broke it down very effectively, I thought. But basically, he doesn't want to give forward guidance for the market to move on. But what he can do is tell everyone repeatedly that the Fed is focused on getting inflation down, that a couple of pieces of data are not indicative that we're going to see 2% inflation anytime soon. The battle is not won. And by doing that, the market is going to tilt towards the hawkish side, because he is being hawkish. But I think what he knows is that inflation is coming down, that the inflation data is good but flawed, particularly on the housing side, and that if he can continue to have a hawkish stance, the market itself will continue to have a hawkish stance. And we've talked about it in the last week that rates are as restrictive as they have been by historic standards, because real rates are so high at every tenor that is having a blunting effect on inflation across the board. And we are seeing that in the data yesterday. You're seeing demand for all goods really start to fall. People aren't going out and buying new cars or used cars. They're not buying houses. Food is starting to crater. I mean, even gas, you'd think it would be more of an impact, but it isn't. And that's not really driving inflation because we're already seeing that unwind. So I think that he's playing the slow game, which is he's going to let inflation fix itself by the market thinking he's actually more hawkish than he is. But I don't think that the average CNBC person, or even, I mean, people don't trade bonds, people don't think about bonds and how they manipulate the market based on where they are in relation to inflation. But he's having a very powerful effect, and I think that that's going to lead us towards the end of the year. And we're running out of time for my initial thought of one, maybe two cuts. I think the war in Iran really threw a wrench in that, but I think that we're more likely to cut in this calendar year than we are to hike. And even since I listed it, or the data just a few minutes ago, we're down to 1.2 expected hikes from 1.3 just in the last few minutes on the heels of this data. And the longer those rates stay artificially high, the more quickly I think inflation comes down, which would actually necessitate a cut more quickly than people think.
I like it. I mean, people are out there listening and they're reacting.
Yeah,
they're hearing the call and they're saying, "Hey."
I mean, it's
expectations are moving.
It's good for us. We have a lot of bonds maturing today. We have our Dillard's bonds, our 775s of 2026. Some of my favorite corporates we've owned for a long time coming off the board, and pretty much every single account that's a tax or a qualified account. So think IRA, Roth IRA, if you've got those in there. So I'll be doing a lot of work today. So hopefully they stay elevated for at least another, call it 6 hours.
Let's do it. All right, good stuff. We'll wrap it up there. We'll be back tomorrow. Tomorrow is tomorrow day. Talk to you soon.